Ladies and gentlemen, the US jobs market is showing signs of weakening, and this sent the entire financial market up. And that's very unusual to most people. Today, we shall analyze it and see how come a bad news have become a good news, and more importantly, what does it spells for the rest of the financial market and the asset. Let's watch on, shall we? So this is a very unusual situation where the US job market softening has sent the entire stock market up. And this is good news for many financial assets apart from the stock market as well. And today we shall analyze this. So as usual, these are my disclaimers. And this content is for education, entertainment only, not financial advice. Please remember hit subscribe for more good news because subscribers now get a lot of benefit. Let's see one of them. So one of the good news for YouTube subscribers of the 1965 channel is that my slides are now available to all subscribers. So all 1965 YouTube subscribers can just submit a screenshot of the thumbs up and the screenshot that you have subscribed to the channel. And you can now submit to the link that is in my description and you can download the slides. Very easy. So more privileges are coming. I think yesterday the subscribers of 1965 channel also get to buy highly discounted a passion fruit that's not even available at the kind of insane prices anywhere else. So many more subscribers benefits are coming. Going back to the video, this is the agenda today. We will take a look at the latest jobs report and also take a look at the implication to the interest rate cut expectation, some analysis to all asset and implications to the macroeconomy and financial market. So as a sign of weakness, the US job openings is the lowest in 10 months. And the July job openings fell to 7.18 million and is the lowest level since September 2023. And this is the first time since 2021 that the job opening per unemployed workers fell below one. That means there are now, less job opening than unemployed workers. So this is actually quite serious. So this is basically showing that there is an overall labor demand weakness. We don't know it's caused by economy or caused by AI disruptions and so on, but certainly this is a sub one opening threshold, and this is quite serious to the financial markets and also to the Federal Reserve. As a result, the CME Fed Watch that watches the likelihood of interest rate cut is now predicting a 74.6% probability that will be a 25 basis points cut in September. So it's almost near certain that the September rate cut is going to happen. And I think we're going to see an interest rate cut for sure. The question is right now, is it going to be what I call hawkish cut or a dovish cut? That's the first one. That means whether Jerome Powell is going to come and just say, wow, we're now in trouble, we better cut, and we better cut seriously, and we watch and see, and we're really cut a lot more. Or he's going to say, I'm going to cut right now, but the situation look bad. Anytime I can bring back the rate cut or stop the rate cut, that kind of thing. That's called a hawkish cut. Now, the question right now is which kind of cut will it be? And the second question is whether they'll cut one more round later part of the year, and we shall see for that to happen. And the decision will come on the September the 17th to 18th, and all the markets are really positioning themselves to capture this rate cut certainty. Now, as a result, the US dollar is now slipping, and this is in anticipation to the fact that now interest rate is likely to fall. And that has always been the reason why US dollar is showing signs of weakening. And also the weakening of the labor statistics, which is the job market, also bring about a likelihood of an interest rate cut and therefore weaken the US dollar as well. So we should expect the US dollar to have some weakening, not crashing. I would just say weakening. And let's anticipate that to happen and factor that into our investment outlook. Now, gold prices is now having record-breaking rally. And right now, gold prices on a per ounce basis reach US dollar 3,500 per ounce. And that's unprecedented level. Okay. And the key driver is that right now, the interest rate cut likelihood have drove the cost of holding, opportunity costs actually lower. As a result, this drive to go up. But I think the other thing that drove the gold prices up is really the geopolitical tension that's still going on. The war is not ending between Ukraine and Russia. Gaza is still one big mess, and the tension between China, US, and the rest of the world is still there. So all this, whenever there's fear and uncertainty, this drives up the demand for gold. And the other one is a lot of central bank right now are buying gold. Okay, so all this drives up the interest in gold. And congratulations for those people who bought a lot of gold. Okay, and I think the question really right now is, will gold continue to go up? The answer is I don't know. Gold is very difficult to predict. But as a rule of thumb, the more dangerous, the more uncertain, the more likelihood inflation is going to be, the more higher the gold price is going to go up. So, and now has fallen below $65. It's now at $63, 70 cents or 90 cents. That range is a very low level. I heard some report that once it go below 60, some of the oil exporting countries are reaching losses level. So the break even is around $60 per barrel. And this is actually quite serious. And this is despite many attempts by OPEC cartel to do some oil control as well. But this is really one of the sign of signal that global demand for oil is going down. Okay, and this is very serious. So in a summary, let's look at all the assets. Bond prices are likely to go up if interest rate is coming down and forecasted to come down even more. Equities has gone up yesterday and set to go up even higher. The artificial intelligence trend is now set to go at an even stronger rate. Everybody must catch up with the artificial intelligence wave right now, or you'll be left behind very seriously, disrupted in a very bad way. The US dollar is expected to go down, okay, some more as the overall Federal Reserve interest rate projection is going to get lower. And last one is gold prices is set to go up even higher. Oil prices is set to go down even higher. This is the current snapshot of all the entire financial market right now. Hard to say with precision that this surely will happen, but this one is likely to happen. So question is, what do we watch out for ahead? So there is a statistics called the US non-farm payroll that's coming out on Friday. This will confirm whether the jobs report that has been released is true or not true. And if the non-farm payroll comes out, that the jobs market is indeed in a weak way, then then we'll home run not just the interest rate cut for this September, you will home run probably an interest rate cut for another time for the rest of the year. And we will know this in the Federal Reserve meeting on the 17th, 18th of this month. And we are trying to see whether there are geopolitical tension that will flash up. If it does, then gold can go up even more. Oil prices may have some volatility as well. We also should be watching closely to see whether there's an inflation, a spurious spike. Okay, and and I think these are the key things. Specifically on the non-farm payroll, also known as MFP, the key number to look at is the headlines job growth. Okay, I think the consensus view is 145,000 versus last one was 165,000. And if the unemployment rate continues to spike up, okay, then this one will cause Federal Reserve to have a hard jump and most likely have one interest rate cut in September and maybe one more in the rest of the year. So the key takeaway is this, that the jobs report showing that the labor market jobs opening softening has now kind of drive the certainty of the September rate cut to a near certainty. Some of the assets like bonds and stock prices are already going up, and gold prices going up, and we look forward to them going up some more. And the critical event is to look at the non-farm payroll numbers and the September FOMC meeting that decides whether interest rate will cut or not. Among all these things that are more serious, there's one extreme case that we need to look at is the Supreme Court ruling on whether Donald Trump's global tariffs are legal or not legal. The Court of Appeal has ruled that Donald Trump's global tariffs is illegal right now. They are appealing the Supreme Court, and we shall see the outcome. It needs to be made by the 14th of October. Please watch my live stream yesterday where I talked about it. I think all these are very interesting to watch. They will cause the entire financial market to have some, turmoil swings. But I think that um, my take is this: September rate cut certainty, and if the market shows that the job market is going to be low, then potentially we have two rate cuts. If two rate cuts would happen, this will send the stock prices and bond prices going up. We don't know for sure, okay? But I have a hunch that this might happen, and I also have a hunch that given that Supreme Court is always in favor of the administration, which is Donald Trump right now, I think they will grant what we call a stay of the global tariffs, allow it stay until some time to come when they have a proper ruling on that. With this, then I think the whole market will be in the path of trajectory of going up with a lot of volatility in between. So thank you for watching. Remember to download my slides for your own understanding. Some of the texts are rather small. Having the notes to read will help you as well. Thank you for watching, and I'll see you tonight, possibly in live stream. Thank you, and have a nice day.